Hello and welcome everyone to our webinar Wednesday. Thanks so much for joining me to have hopefully some target date fun today. I'm Laura Nino, as mentioned, a senior investment consultant and really a target date fund specialist here at FlexPath RPAG. Today, I'll provide you with a few topics for really facilitating the target date fund conversation with your clients and prospects. And then I'll demonstrate how you can document the target date fund selection process by conducting a plan fit analysis using RPAG's super quick and easy target date fund analyzer tool. As always, there are plenty of resources available to you here at RPAG, and we are more than happy to help with any of the items that I'll be talking about today. It's as simple as reaching out to RPAG support or your FlexPath sales team representative, if you know who that is. And then for some of those resources, those are as follows. There is, of course, the Target Date Fund Analyzer tool that we'll be discussing in detail later in this presentation. Through the tool, you can run a plan fit analysis to determine target date fund suitability and generate a comprehensive target date fund specific report to walk your audience through as the target date fund expert in the room. As you all know, the RPAG Resource Center is also a wealth of information. Under CITs and custom target date funds, we do have the DOL target date fund tips sheet and all of the FlexPath participation agreements, the target date fund overviews, and the quarterly update decks as well. There is also some participant material on there and other marketing material, so absolutely check it out. There's some one-pagers too. Feel free to take a poke around, and I'm sure you'll find whatever it is that you're looking for. For some additional FlexPath target date fund information, flexpathstrategies.com houses the fact sheets, some interactive tools and videos for some target date fund education, and then most notably the Discover Your Path tool to really help participants select their most appropriate FlexPath vintage and risk level if they're looking for a little bit more of that hands-on guidance. And then finally, as I mentioned before, RPAG support and the FlexPath team would love to help you with your target date fund needs, including helping to run your plan-specific reports, any target date fund comparisons, or TCAs, total cost analyses. So again, feel free to give us a shout for hopefully some target date fund. And with that, let's get into some target date fund education. So the next few slides here are actually in the target date fund fit analysis presentation that you would generate in the RPAG system. And I'll be speaking to them as I would with a client, hopefully helping you be able to take some highlights from what I say. First, I wanted to highlight the need for a due diligence process around evaluating and selecting a target date fund for a plan. And of course, we need this process because of increased usage of target date funds, differences among like-dated target date funds. So not all target date funds are created equally. And then, of course, everything we do to protect participants and really mitigate fiduciary risks. First, we focus on the target date fund selection process because target date funds are one of the most widely used investment vehicles or investment options in defined contribution plans. And really, most 401k plans within the industry are using a target date fund as the plan's default investment. So with such proliferation in the industry, the DOL does recommend spending a little bit of time going through some education on what that target date fund landscape looks like. Now, when considering different target date funds, as I mentioned earlier, it's important for us to keep in mind from a fiduciary standpoint that not all target date funds are created equally. They each have their own glide path, or in other words, each target date fund manager creates their own stock and bond allocation mix and their own strategy for de-risking participants as they approach retirement. And as you can see here, each manager has their own philosophy, and they definitely do this at different rates, giving us this large distribution of risk levels. So what we've done here on the slide is really overlay the 100 plus various target date fund glide paths available in the industry. And depending on which series is selected for the plan, there could be a difference in equity exposure of as high as 55% at retirement. And those differences have absolutely led to a wide variety of outcomes for participants. So I mentioned the differences between series can be pretty significant, right? And an example of that would be if you look at what happened to 2010 dated target date funds during the global financial crisis. This chart is showing from November of 2007 to February of 2009. So someone expecting to retire in maybe, 2010 is maybe 1 or 2 years away from retirement with one foot out the door. And while negative returns could have maybe been expected during this time period, it's really the difference in how much that we need to consider. So best case scenario, you lost 10%, worst case, you lost 51%. And that really got a lot of individuals thinking and looking at the differences in risk that are associated with their target date funds. Sometimes, to give an example, I like to think about two neighbors, right? Both maybe 64, 65 years old, ready to retire within 1 or 2 years, both fully invested in their company's retirement plans, and I would say similarly funded for retirement for purposes of this example. So the one who lost 10% may still be able to retire close to on time, but the one that lost half of their account balance is likely going to have to delay retirement. And I think the most important thing to note here is that both neighbors likely expected to have pretty similar performance from their equally 2010 dated target date funds. We also saw similar trends throughout February and March of 2020 at the onset of the COVID pandemic. At the time, those participants invested in a 2020 dated target date fund. At best, you were down 8%, at worst, down 24% in your portfolio. So another key here is that participants approaching retirement may not always have the luxury to wait for the market to rebound. Maybe you're taking care of a loved one. Maybe you have health issues. There's plenty of reasons why someone, might not just be able to work another few years before they can retire. So I don't think, it's always super fair to say, hey, the market rebounded really quickly. They can just wait around a little bit longer for that rebound to happen. So where this is all going is the Department of Labor actually came out with some guidance for fiduciaries on what our process should look like as we select and monitor target date funds for a company's plan. And what we've done is summarize that guidance here. Keep in mind as you read through some of these comments that none of the tips are necessarily specific to performance. But they are specific to this concept that we need to align the target date fund to participants' characteristics. So looking at the bullet points here, first up, aligning the target date fund with participant characteristics. RPAG's approach to this is by assigning every target date fund in the universe a risk rating of either conservative, moderate, or aggressive by looking at various equity points along the glide path. And then for participant characteristics, that's where the fit analysis determines the best fit risk profile for the average plan participant. And then from there, I'm sure you can do the math. If the average plan participant needs to take on maybe a moderate amount of risk to reach their retirement goals, we would align that plan with a moderate target date fund. Next up, understanding the underlying investments. Again, RPAG implemented the DOL's guidance by highlighting the importance of underlying funds with one, our blended score approach on the target date fund scorecard. So for those of you that aren't familiar, we take a blend of the selection score and the allocation score for a target date fund, and we average them out to get a blended score for the series as a whole. And then we've also taken underlying funds into account with the underlying fund scorecard feature, where you can pull the scorecard on just those underlying investments so you can take a deeper dive looking into a target date fund series. I think it's also important to understand if the underlying funds of a target date fund are active, if they're passive, or a hybrid of both. Also, if they're either proprietary funds or if that series uses an independent investment selection approach within the selecting of their underlying funds for a series. Next, reviewing fees and investment expenses. Of course, we're doing this. We do this, as we do with any of our core lineup funds. And then I think the next bullet point is maybe the DOL's acknowledgement that the plan doesn't necessarily have to go with the cheapest option that's available, which I think many people can fall prey to when thinking about investments and fiduciary risks. So consider something custom or non-proprietary. You might know the FlexPath story, but just a little shameless plug here. We have had some massive success with FlexPath's custom solutions business, very much attributable to you and your clients. So highlighted in Sway's 2024 research highlights, FlexPath is the largest multi-glide path target date fund provider with 89% market share. And FlexPath is also the fastest growing target date fund provider over the last 3 years with 65 billion plus in assets under management, while just passing our 9th year since inception. So consider something custom or non-proprietary. I had to give a little plug for FlexPath there, but there are other options out in the industry as well that are becoming more popular. And then lastly here, of course, document the process. So again, if the DOL recommends spending some time documenting a process for evaluating and selecting target date funds, RPAG is absolutely doing it. And the plan fit analysis is how we do that. It is an analysis that considers plan demographics and participant tendencies in order to identify a best fit risk profile for a plan. So conservative, moderate, or aggressive. And then determining that best fit risk posture is really the first decision that we should be making when selecting a target date fund for a plan. So for the QDIA, this risk level should align with the needs of the average plan participant determined in the fit analysis. A plan, for example, with mostly high savers that are well funded for retirement may need to consider a more conservative target date fund. And vice versa, a plan with low savers who are maybe underfunded for retirement, they might need to consider a more aggressive target date fund risk posture. And I think it's also an appropriate time to mention that, I guess, the FlexPath outlook on multiple glide paths. So in a traditional target date fund, you would only be able to offer a single glide path that is unlikely to satisfy the needs of every participant. So a participant's age would be their sole determining factor for their asset allocation. But with a custom target date fund through FlexPath, the plan would be able to offer multiple glide paths, so the conservative, moderate, and aggressive, to hopefully satisfy the needs and desires to take risk of all your plan participants, or most. You would simply select one of the glide paths for the QDIA default, but you would still be able to offer the other risk levels for participants that do maybe fall out of that average, plan participants' needs that you ran the analysis for. So how do we run the fit analysis and determine that best fit risk profile for a plan. Well, I'm going to walk us through that today. And this is where we start. We start by collecting the data for the analysis. You can either send an RFI out to the plan's record keeper, or you can just request their most recently generated standard plan review report that most record keepers put out every quarter. On the screen here, I'm showing an example of the RFI that the FlexPath team will send out when we run a fit analysis for a plan. You can create your own set of questions if you would like, or you may absolutely reach out to us to use our RFI template if you wish. And then once you've collected all of the plan data, you're ready to use the Target Date Fund Analyzer tool. And you can find that by hitting the menu button at the top left of the portal. And then under Tools, you will find the Target Date Fund Analyzer. So those are both circled right there on the screen for you to have a little visual. And then once you are in the tool, you will see two different report options. You can run a target date fund fit analysis, which is what we are doing today using plan specific data. Or if you don't want to use plan specific data and you just want to go to your client or prospect with a comparison of a few different target date funds, you can do that as well using the custom target date fund comparison option below there, where again, you don't have to collect any plan specific data and you can just simply compare different target date funds of your choosing. So to begin our target date fund fit analysis, though, you would simply start by naming your report and then click Start, and you will be taken to step 1 of 3. This is what step 1 looks like. You will use the information, the data that you have collected from, again, your plan's record keeper to help you answer these fit analysis questions. You can see here that there are 3 different decision trees. So the plan objectives, plan demographics, and participant behavior. And each of these decision trees will show a conservative, moderate, or aggressive result depending on how you answer these questions. So if you were to change the answers, I'm just going to, for this example, leave them all on no. But if you were to change some of the answers to yes, the system would automatically change that result from conservative, moderate to aggressive for you. In our example here, though, again, we have one of each risk posture. So conservative at the top there, aggressive in the middle, and then moderate on the final decision tree. And then on the back end, the system will be averaging the results of those 3 different decision trees to come to an overall best fit risk posture for the plan. So again, in this example, we had 1 conservative, 1 aggressive, and 1 moderate. So the overall result for the fit analysis is a moderate approach being the most appropriate for the average plan participant. And then from there, once you have that overall result, your goal is to help your client select an appropriate target date fund for the plan within that best fit moderate sleeve. You can put together a comparison of a few different moderate target date funds to then bring to your meeting. Maybe you compare BlackRock LifePath Index for a passive option, JP Morgan Smart Retirement for an active option in the moderate space. And then you can also add in maybe a custom target date fund like FlexPath that offers, again, the moderate glide path as well as an additional conservative and aggressive option. There also is an option on the screen for you to include the incumbent target date fund. So say the incumbent target date fund that they're already using is not moderate. You will have the option to include that in the report as well. So the committee and yourself can compare the existing target date fund to any new proposed options. And then here's the third and final step where you will build the report. This will look and function the same as any other report builder that you use in RPAG. One thing that I will point out is under RPAG templates that I have circled there, we have the standard template option for you to select if you wish. I do highly encourage you to use that template. This will give you the standard fit analysis deck that does include the slides that I spoke to earlier. It's a really nicely built out deck, starting with some target date fund education and the need for a due diligence process. It then takes you through the fit analysis results that you just ran in this system. And then it will end with the target date fund comparison section. So you can look at the income and target date fund versus any other proposed funds that you've included in the report that you selected in step 2. So I know that was a lot of information, but in practice, the target date fund analyzer tool within RPAG really does make the target date fund due diligence process so quick and simple. I use it all the time. Honestly, it takes me like 5 minutes. It's really the majority of the time spent in creating this report would be in the data collection process, going back with the plan record keeper or the relationship manager or record keeper. So the data collection happens before you even open the tool in the system. But once you do have all that data, it's really, as you saw, a very quick and simple process. So if you'll bear with me for a few minutes more, I also wanted to point out one other slide that would be included in that standard template, which is a really good visual for retirement plan committees and frankly simplifies suitability as much as possible. It's pretty cool because in the system you can customize this slide to show your clients actual participants' savings rates breakdown and data in this bar chart. So if you look at, excuse me, if you look at participants' savings rates, that's probably the strongest indicator of how well funded they are for retirement. And generally, those saving less than 6% need maybe more of an aggressive glide path. Those saving anywhere between 6 and 12% can maybe afford to de-risk a little bit to the moderate glide path. And then finally, those that are saving greater than 12% can further afford to maybe be more conservative. Also, I'll mention that the results shown on this slide will typically line up pretty well with the overall fit analysis result for the plan. So both of them will typically point to the same risk level. When we look at this sample plan, there seems to be a lot of diversity that exists among participants. And, you know, I would say in my experience, that's pretty common to see. If you're familiar with the FlexPath story, this really just justifies the benefit of having multiple glide paths. So participants won't be limited to a single glide path risk level. You know, if you went with a traditional target date fund and you were to select moderate based on this fact set as the, you know, most appropriate average risk level for the plan, you would be leaving out still a big chunk of the participants that might need that more aggressive or conservative risk posture instead. And then I also wanted to show a more homogeneous group here. So keep in mind that people take risk for 2 different reasons. There's first the need to take risk, but then you also have the desire to take risk. So again, even if this chart looks really homogeneous, like the example that I have up here, and everyone is saving the same rate, there may still be an inherent desire for differences in risk as well. So again, if everyone maybe looks like they'd benefit from a pretty aggressive glide path. It doesn't mean that all of these aggressive participants would want to, I guess, would desire to invest in an aggressive way. So they might like a little bit more security and want to move to maybe a more moderate glide path. So again, there's a need to take risk and a desire to take risks. So that is just something to keep in mind as well. In all, this slide is really a more objective way to decide whether custom options such as multiple risk-based glide paths should be considered. On the previous slide, where the group's savings rates were more diverse, it may be worthwhile to have a custom multi-risk target date fund implemented. And then alternatively, for the more homogeneous plan that I have on the screen here, where the majority of participants maybe don't contribute a lot, they may be better suited for just an aggressive glide path target date fund. So there's, maybe less need for considering a more custom product. All right, we've reached our conclusion here, where I just wanted to leave you with a few key takeaways. So first and foremost, of course, target date fund prevalence necessitates increased due diligence by plan fiduciaries. We must conduct due diligence research to document a fiduciary process for evaluating and selecting target date funds for a retirement plan. Next, I'd say we should aim to run the plan fit analysis every maybe 3 to 5 years or so, or as needed as a plan's fact set changes. So, say you just did a fit analysis last year for a plan, but then the plan went through a huge acquisition, and now there's a lot of new participants to account for, and just big plans or big changes were made. That might be a good time to rerun the fit analysis again to identify or confirm the best fit risk profile for the average plan participant. And then finally, of course, leverage the target date fund analyzer tool in the RPAG system to quickly run that in-depth analysis on your clients or prospects plan on their current target date fund offering and other target date fund considerations. The report really is so comprehensive. Highly recommend you taking a poke around even before you might have an opportunity to use it on a real client or prospect. It really is just a good research tool as well. At least that's how I like to use it as well. As I mentioned, FlexPath and RPAG are always happy to help you with any of these reports, anything that I talked about today. So absolutely reach out if you have any questions that come up later on. But for the time being, thank you so much for joining me today. I hope you had some target date fun.